Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. We'll take all things crude with James Davis of FGE Nexantica. Not just that, we will also be putting spotlight on cryptos with Edul Patel of Mudrex, who will be joining us on the show as well. But first, let's take a quick look at the global markets. The S&P 500 finished 0.5% on the higher side, closing at a new record after hitting an all-time highs during the session. The Nasdaq Composite also gained about 0.7%, also scaling a fresh intraday and a closing record. The Dow Jones, in the meanwhile, climbed 0.5% as well. The Wall Street, in fact, is poised to close the week in the green, bolstered by earnings optimism. The S&P 500 is also up 0.5% through Thursday's close, and the 30-stock Dow on track for a 0.3% advance. The Nasdaq is the outperformer, heading for a 1.5% gain. A mixed show across, though, is what we are looking at in the Asia-Pacific markets. As you can see, there's no clear direction that we can see on the screens with that one. But shifting focus to the money markets then, and the dollar index is on a track for a weekly advance as the macros lift sentiment, and moderate expectations around the Fed's rate cut bets is what the street is working with. The greenback is poised to close the week higher by nearly 0.7% as of now. Meanwhile, it is the prices of the crude oil which have risen as street weighs on low inventories and renewed geopolitical risks in the West Asia. The prices are expected to be volatile here on over the final scale of the U.S. tariffs and their impacts on the global growth. James Davis now joins in to talk about more in sense of the crude oil prices, on what cues should you be watching out for and what could really be the strength from here on. James, hi, I really appreciate your time here on. And since we're talking so much about prices, if you look at the first half of this year, it has been a wide range. And that's is that what you're looking at for the second half as well? While we seem to be holding around that $70 mark, James, the funny part is that there are a lot of reports suggesting that we could be going to 60 or below. And then there are reports suggesting that we could be heading to 95 or even 100 for that matter. So clearly it's anybody's guess with the way the markets are right now. What is it that you would want to watch out for, and what's your sense on price range going forward from here for the rest of this year?
I think last time I was on the show about a month ago, we highlighted a range that could be sort of $60 to $80 a barrel in the near term, and that's still somewhat in the framework that we're looking at the moment. For the rest of the year, there's two main themes that we're looking at. One, on the demand side, will be how the tariff situation evolves and whether there's going to be any repercussions that could impact that, and we can talk about that in a moment. And that can have quite a significant impact on the dollar to some extent as well, and what the Fed does next week. You've already touched on that in your opening remarks just now. And the other huge unknown that we're looking at is what happens to OPEC production. And it's views from the market that OPEC will keep production high towards the end of the year, and there might then be a surplus. Are the ones that are driving the views that prices will go lower, prices will go to 65 to 60 and perhaps below. There could be a scenario where they decide to revert back to market management and support prices, something that we think is perhaps slightly more likely as we move into 2026 and we start to see some of that length that everyone's expecting emerge. So the range that can still be wide. There's still a lot of uncertainties. Right now, we're sitting around $69, $70 a barrel. One of the reasons we are there is because we've got such a weak dollar relative to where we were earlier in the year. But you mentioned volatility and uncertainty. That's still very much what's happening right now.
James, as we speak, and it was just a few minutes ago that we saw European Union's 18th package of restrictions or sanctions coming on Russia. How are you reading on this? Because from what I was going through the details, it says that 47 or something or thereabouts is what they want to cap. The G7 wants to cap the crude prices in sense of Russia. Your first sense on the price itself, 47 or some, even as we look at Brent trading at a 70 and WTI at 68, putting a cap at 47, what would that mean for Russia?
First, when we think about the price cap was there to limit the cash flow of Russia. It wasn't there to limit the flow of oil. So the idea of the price cap initially was to set it at such that Russia would still receive revenue to be paid to pull oil out of the ground, but it wasn't going to be given any incentive. It wasn't going to be given any big cash return. So just about enough price cap so that they can produce and the oil flows to market, but they don't have any spare cash. So they set the price cap at around $60 a barrel, which was deemed to be the break even of where they were. If they come and lower that price cap, it's almost an admission that they set it too high in the first place. So we do find it slightly awkward, the approach that they're taking. In anything, it's a knee-jerk reaction to where prices are today, and it's not necessarily a reaction to the fundamentals which have driven where that price cap was in the first instance. Now, whether they set that too high in the first place or not, that's up to them to decide based on the economics they're looking at. What we did see, though, was very little impact to the market. Even at 47, maybe $50 a barrel, it's probably still not going to make a huge impact to flow to the market, but it does potentially add trade friction. These barrels are going to go to Asia, most likely, as they have been. They'll go to Indian refineries. Maybe there's a bit of a challenge there. They're always very conscious about making sure that they're doing things within reason. Some will go to China, some will go to other parts. And it's trade friction, and it's the slowdown of trade rather than the halting of it is what we really look at. And that slowdown of trade and that trade friction can create some higher pockets of prices, particularly in the freight markets, particularly as things get tied up and slow down.
James, and I'm just reading this as the reports come in that the EU sanctions will also include Rosneft refinery in India. What does that really mean? Because I do understand that imports into India perhaps will not be so much impacted, but the Rosneft refinery in India, what impact do you see that bringing in?
Well, it's shifting the emphasis onto products, and there's been a very tight product market over the last few months, particularly on the diesel side of things. And diesel moving from the east to the west has been something we've been keeping a very close eye on, especially as the West has struggled to make enough diesel over the last few months. We've seen inventories incredibly low. So it will just continue to add that trade friction, as we said, not just on the crude markets, but also on the product markets.
Clearly, this is a developing one, James. And of course, we'll keep hearing from European Union as we read those reports right now. And of course, the US president also has been threatening Russia in various ways there. So I'm assuming with all of this going on, we don't see a lot of premium come in for crude oil prices. Why is that? Because this should have a larger, longer, bigger impact, wouldn't you say?
Well, we've still got relatively firm crude prices when we consider what the market's looking at right now. One, we've got very tight stocks, as we've discussed in the past. But two, the market's looking forward to what it thinks is going to be a big surplus towards the end of the year. And we've seen that being priced in different ways. And then as those things are priced in, you also see the near-term pressures getting priced in when you get shocks to the market. Some of the big shocks that we've seen in the last month have been supply shocks in Ecuador, supply shocks in Colombia. You've currently got close to 400 kbd of production capacity in Canada that's at threat of wildfires that are out of control. We've now seen some shut-ins in the KRG, I think close to 200 kbd, although that probably won't impact the wider market. So there's a lot going on there, which has helped support prices right now. But at the same time, we're also starting to see some of the signs that the supply length that's coming later in the year, particularly from non-OPEC sources, is starting to emerge. One of the high-frequency data points that we've been looking at is daily production from Brazil, which is beating our expectations. And it's Brazil and some of the Latin American producers, which is where a lot of this year-on-year supply growth is going to come from later in the year. And now that we've got evidence that this supply growth is coming, that's going to be capping gains at the front.
James, how would you look at the demand growth going forward from here? I mean, you've talked about supply on how we perhaps could be looking at a surplus by the end of this year. But when it comes to demand, with slightly better economic data that we've seen coming from China, US, and as you mentioned, the Asian growth continues strong, do you see support coming in from that part?
It's one that can offer support in the near term. We've seen, when we look at the trade data, specifically looking at China imports into the US, We saw a drop through April and May, and very much a response to the tariff risks that were put in place, and then a gradual recovery in June, and then a pretty big jump up in July is what we're looking at now. And that trade impact can directly impact transportation fuels, particularly diesel. And we saw a bit of a lull in diesel demand within the US. And we can see a slight recovery materializing now through June, and probably a fairly big step up to be expected, at least month on month through December. Sorry, through July. And it's that whipsaw type response from these tariffs that we then see filtering through into end consumption for diesel and for transportation fuels that is what we really have to manage. And it's very difficult to pin down exactly how this is going to play out because of the uncertainties. But it's certainly one that's keeping demand on its toes and influencing it. We've seen that lull in the past. We've now seen a bit of a recovery. Where we'll go, whether we can actually see a complete removal of these tariff fears and then healthy activity thereafter. That's what obviously the bullish people out there would want to see, but it's not quite the trend we're expecting. There will still be some concerns, some pressure, some downside that will limit the growth there. But on the flip side, we've also seen some pretty healthy flight figures from the US. We've seen some not stellar gasoline numbers coming out of the EIA, but we've seen the activity levels specifically around the 4th of July looking really healthy. So there's consumption there. There's some good signs for economic activity. A lot of people will be looking to the PMI, the flash PMI next Thursday to see how that falls in line with expectations as well. In terms of absolute numbers, we're looking still just below 1 million barrels a day of year-on-year growth for 2025. That seems to be on track at the moment. It's slightly better expectation we had last month, but there's still a lot of uncertainty that we're looking at because of these tariffs. And that's really the big challenge.
James, I'm just penciling down these numbers. So as you said, 1 million barrels per day of a demand growth is what you're anticipating in 2025. If I had to match it with the kind of supply that we could be looking at in 2025, what is that going to be?
Yeah, it's not going to come close to the non-OPEC supply growth that we're seeing. And then when we factor in what's happening to OPEC and what they're going to do, what they are doing so far, it's going to fall short by a million, maybe 1.5 million barrels a day. We might be seeing 1.6, 1.7 million barrels a day of non-OPEC supply growth. And then when you factor in processing gains and biofuel supply, that pushes that number up to 2 million barrels a day. So you've already got a 1 million barrel a day gap between supply and non-OPEC supply and demand. And then on top of that, you have what OPEC Plus are doing. And that's still a bit of an unknown about what they're going to do, not only for September. The assumption is they're going to accelerate the unwinds, but also for the fourth quarter, about whether they will maintain output at high levels or whether they'll actually pull back and go to market management. So there's a bit of an unknown there, but there's already a gap between demand and non-OPEC supply. But we can't always just look at the growth. It's really important to look at what the balance was in the previous year as well. Because if we're coming from a deficit year where stocks are drawing down, you can afford to have a little bit more supply than demand the following year just to catch up on that previous year's deficit. And that's something that is really important to keep track of as we're going through the year.
James, there are a lot of traders out there as well who are taking positions on bearish and bullish crude prices there. From where we stand and the whole host of fundamentals, factors, impacts that we're talking at, what would you tell these investors? Do not go short at any point. Do not go long right now. I mean, it's a difficult time, right? Because there are just so many case scenarios playing out. What is it that you would advise a bear or a bull right now in case of crude prices?
It's there's a huge amount of uncertainty, and we're seeing that, and we're hearing that with the conversations that we have with people in the market, and it is incredibly difficult to take a position on anything, especially when we've had certain movements. A few weeks ago, things were looking pretty tight for crude, and it looked like we should see prompt spreads improving. They've done that. We're now in a position where the market is pricing in for a reduction in spreads throughout the rest of the year. And that's what we would expect to see. There are still some upside risks to structure as far as we're concerned, and that would likely come from cost reverting back to market management, perhaps even tougher sanctions on Iran, and some lost supply there. And demand can outperform, supply can underperform, and those things can all be relatively constructive. But it's a very, very difficult time right now to have any clear conviction based on where the market is pricing. The market's been very efficient at pricing things in and pricing in forward expectations. And a lot of people's expectations are aligned in terms of seeing a surplus for the end of the year. And that's what we're seeing in prices, and it doesn't create a huge amount of opportunity for speculators right now.
Oh, absolutely understandable. Very, very difficult timings here with so many things changing almost every day on an everyday basis, and that's what's keeping the prices volatile. James, thank you so much for joining in with a sense on, of course, our breaking news as well, the prices, and of course, on what we see in sense of demand and supply going forward. Appreciate your time. And with that, it's time for a snappy break. On the other side, though, we'll talk crypto with Edul Patel of Mudrex. Stay tuned. Welcome back. We'll talk all things crypto now with Edul Patel. He is CEO at Mudrex. Edul, hi, thank you so much for joining in. First of all, the last 24 hours clearly have been very, very productive, if I can say that. In the US markets especially, it has been a crypto week, and every day has been worth following for crypto enthusiasts there. But overnight, the way we've seen Clarity and Genius and the anti-CBDC surveillance bill go through, I mean, of course, it just has to be signed, but the major work or the groundwork clearly has been done. How are you reading into this?
Yeah, firstly, thanks for having me here, Manisha. It's been a very exciting week for everyone who's been in crypto, especially for people like us who've been in this space for the last 8-10 years now. It seems like a landmark week where a lot of clarity has come into the space. We've seen 3 landmark bills being passed. One is basically a formalization of how stablecoins need to be structured. The second is a clear diktat from the House that there is no central CBDC which will be created, which opens up the markets further. And then there is a Clarity Act, which gets more clarity around how digital asset markets will be created in the US. US has historically been like a leader in terms of regulatory clarity coming in, especially for newer assets. And this sets the benchmark for most other countries to follow. So it's extremely exciting. It also feels very rewarding to eventually see regulatory approvals come in for a lot of these different pieces in place. I also would love to emphasize that what's happened is all of crypto, which earlier used to be clubbed together, has now been broken across different pieces, right? Like last year, we saw Bitcoin being separated in the format of Bitcoin ETFs coming in and a formal regulation around that happening about a year and a half ago. And 18 months later, we are at about $160 billion in crypto ETFs. That's roughly half of all gold ETF balances now. So it's a very large landmark that itself has been reached. We then later on this year have now seen Genius, Clarity, and the CBDC Act coming in, which basically separates out stable coins and the rest of crypto as well. So crypto, which was earlier all new finance, has now been broken down into a store of wealth, payments infrastructure, and rest of crypto. And I expect that as the years progress, we will see more and more clarity for the rest of crypto as well. So very exciting.
It is. And Edul, as you mentioned, while the US clearly doing a lot and taking a lead on to this one as well, how far or how behind do you see India?
I think India historically has shown a lot of gumption towards moving ahead, right? Like if you look at how things have progressed, in 22 we got a clear taxation structure. In 23 we got a licensing regime or a registration regime for our virtual asset service providers. Now we led the G20 presidency where we spoke a lot about how crypto needs uniform global regulations. And now that there is so much clarity that's come in on the US side, plus Europe going ahead with the MiCA regulations, which are similar in nature and tone and spirit to the US regulations as well, we see these 2 large, let's say, global geos going ahead and proclaiming their own stances on crypto, and that will eventually lead to a cascade towards more countries adopting, including India. So I think we are very close to a discussion paper that should be rolled out. That discussion paper tends to be typically followed by consensus building inside of the country, which then leads to a formal regulation coming in. I think what will also be interesting, and Manisha, the way I'm seeing it happen, is that we will likely not get a one single formal regulator for everything crypto. But just like how the rest of the world has broken crypto down into stablecoin separate and Bitcoin separate and something else separate, I expect that what will happen is that in India we'll also see something similar. We will see stablecoins likely to be looked at from the lens of cross-border money movement and cross-border payment mechanisms. We will see Bitcoin and some other assets being looked at keenly from the perspective of securities and wealth building, and then rest of crypto will just take some more time to catch up.
When you talk about the Indian markets as well, Idul, we do understand that initially there was very strong numbers that we saw. I mean, 2021 was a landmark year again, where we saw very, very strong peak numbers coming in. Since then, and especially after taxes, I mean, yes, it was a moment of recalling, but these are very high taxes then yet again. And then it's also about licensing. From where we stand right now, the last couple of years haven't really done so much. This year, the expectations are really high. What are you anticipating? What would you want to see India do in this year?
Correct. So I'm assuming when you are talking about what India do this year, you mean how the market behaves, and over there, I think the telltale signs that we are seeing in India are very similar to what we are seeing in the rest of the world, right? Like retail adoption is already very high. A lot of people had already participated inside crypto, but not really in meaningful scale. And the last period has left them kind of sour, and they are now slowly and steadily coming back now that all of them are seeing newer highs in crypto, understanding and re-emphasizing on the fact that crypto is not something that you want to dabble into just to make quick gains, but it's that long-term asset holding. The other very interesting thing that we are seeing is the adoption amongst HNI investors. We are seeing HNI investors, institutions, family offices dive into crypto and Bitcoin at a much faster rate. And this has specifically started to happen over the last 6 months. I think it's a cue that these institutions, these family offices, these HNIs are taking from their global peers, where global peers are participating in the ETF products or buying and holding Bitcoin by themselves. In India, such institutions don't have access to similar products. So eventually they are now capitulating and just ending up buying Bitcoin and holding Ethereum, holding Solana and some top assets like this. So we've seen a surge of activity, especially in the HNI, UHNI family office institutions bucket. The retail bucket continues to grow slowly and steadily, but they're no longer doing it from the perspective of, buying and hoping that it doubles in the next 20, 25 days, but doing it from the perspective of long-term asset building and long-term wealth building.
Oh, well, absolutely. If you've been watching crypto, it has seen its summers and winters and then those flowering days and bloom and etc. Having seen all of that, and from where we stand right now at an all-time highs, would you say, Adul, that this is backed and this is a different time because we have ETFs and we have US regulations, institutional corporate adoption is really strong, and the way the prices are sustaining, it's leading to more and more people coming in. Is this, would you call this maturity? Would you call it a moment where you finally arrived? And do you see now more people getting in, participating?
Correct. So I definitely look at price, but for me, more than price, what's more important as a sign of maturity is volatility. And if you look at Bitcoin's volatility, it has just continued to go down over the course of the last few years. At this point in time, the volatility of Bitcoin is near or on par with, let's say, small cap stocks in India, which I think is great. It's continued to go down. It is further reducing is what we are seeing. And that reduction is primarily being driven by the onset of these large institutional investors coming into crypto. And what we're consistently seeing is that there are always people willing to buy once Bitcoin goes below a certain threshold price. And there are always people willing to sell once Bitcoin goes beyond a certain threshold price. And as a result, the volatility range has continued to shrink down. And the volatility of Bitcoin has continued to go down. That is a great sign of maturity. And that's what you want to see in assets that are traditionally that traditionally or historically have been store of value assets. When you're wanting to, when you're comparing Bitcoin with gold, which is also a store of value asset, what you don't want to see is high volatility. What you want to see is low vol and broad participation. And both of those things have started to happen now with Bitcoin over the course of the last year, as ETFs have matured and as more and more and more AUMs have flown into Bitcoins.
Irul, I did not say that. You said that. You compared Bitcoin with gold. So when you do that, what is it that you're looking at in the markets? Because we've seen an all-time high in gold, all-time high in Bitcoin too.
Yeah, so I think what we're historically, Bitcoin and gold used to be uncorrelated. For that matter, Bitcoin used to be uncorrelated from most other assets. In the last 6-month phase, what we are seeing is that the correlation has gone up, and primarily it's gone up because both the products are being viewed from a similar lens. They are being viewed from the lens of hedges against inflation, used from the lens of hedge against the dollar hegemony, viewed from the lens of store of value and store of wealth over long term. So what we are seeing is participation in Bitcoin from that perspective. The difference is that Bitcoin is more global. At this point in time, more people in the world own Bitcoin than people own gold. The participation in Bitcoin from institutional investors has started to grow. And we are actually seeing Bitcoin continue to follow the trajectory of gold as things progress and as the world goes through this tumultuous period of uncertain tariffs, uncertain trade wars, uncertain geopolitical tensions, and prices moving in very different ways as compared to what we've historically seen. Like, for example, historically, we've never seen the US Treasury bond yield be at such a high rate for such a long time, so consistently, right? And we've not seen inflation in most years be at that high rate and not tapering off the rate at which we want to.
Sure.
Yeah, so a lot of things going on.
Absolutely, Atul. This is an interesting conversation, and I hope to see you very soon yet again. Hoping that we see that India discussion paper also out by then, and there's more to talk about then, and see where the Indian markets also want to go with this. But really appreciate your time. Thank you so much for joining in, and thank you for that very, very interesting discussion as well. But with that, that's all the time that we have on this edition of Big C. Thank you so much for watching. Till we see you again on Monday with more news and updates, of course.